The P ratio is honestly, it's one of the most commonly used and widely known metrics for valuing a stock. The reason it's easy to understand and implement, we use it all the time ourselves. The problem is that it is also subject to misuse and some pretty costly mistakes. So what are the three things that you never do when valuing a stock with PE? Number one, don't use an earnings figure without knowing what goes in it. There are a lot of sources where investors can go to get the earnings per share figure for a company or even a calculated PE. They might go to a financial website. They might go right to the company's income statement or other various reports, presentations, and articles. But you really have to beware about these sources of information because a lot of times they're going to give you earnings figures that are not accurate and are actually, in some cases, highly misleading. So what are some of the reasons why this information can be misleading? Well, one would be common errors in digital data. We see this all the time. This is why you can never just take the earnings figure or a PE ratio from a website and trust that. You have to confirm it yourself. Complicated and messy accounting. A lot of non-cash gains and losses that really muddy the waters of what the real earnings are. Aggressive adjustments from management when they're calculating non-GAAP or adjusted earnings per share. And sometimes also fraud and intentional overstatement of earnings. So let's take a look at this example. So this is a company which, if you look to the bottom line of its income statement, looks like it's transitioned into profitability with $69 million of net income. But when we look deeper into the financial statement, we can see that there are a lot of line items here that are adding to this earnings figure, which aren't real. They aren't real economic cash flow based items. We have unrealized gain and changes on fair value of assets, unrealized gain on derivatives. That's $166 million gain in this period. Lots of unrealized gains, foreign exchange, recovery of receivables. These items have no economic consequence for you as an investor, and they need to be factored out when calculating earnings and calculating a PE ratio. You want to know what's real? Cash flow, the cash flow statement. And if we go to the cash flow statement of this company for the same period, we can see that there's actually a negative cash burn of over $81 million. So highly misleading earnings reported on the income statement. This isn't necessarily the company trying to be misleading. This is just the way that accounting works. You need to dig into the numbers. You need to make adjustments where necessary. But the fact of the matter is, most financial websites and articles, they don't pick up the real earnings. They'll just pick up the reported figure. Number two, never rely on trailing earnings as a reliable indicator of future earnings. The market wants future growth. It's common practice to calculate the PE using earnings over the past 12 months. The benefit being, you know what these earnings are. But the problem here is that the market only cares about future earnings, not the past. The market is always looking forward. Low PE ratios often signal the market's expectation that earnings are going to decline in the future. Let's take a look at this company. You may come across it and see that it's a $35 stock that generated over $20 per share in earnings in 2021. This puts the valuation at 1.7 times earnings. A 1.7 PE, that sounds really cheap. But when we look forward, we get a different picture. Based on analyst consensus expectations, earnings are expected to decline around two-thirds, losing two-thirds of their earnings by 2023. This means that the price to earnings ratio when we look forward is actually much larger. It goes from 1.7 times to 4.7 based on 2023 expected earnings. Now, you may still think that this is a cheap PE multiple, but you still have to look at what the real PE multiple is and not what the PE multiple is based on past earnings per share. And as we look forward, if earnings continue to decline, this PE multiple can also continue to increase 10 times, 15 times, 20 times, and it can keep going. Number three, never assume that a low PE ratio means a stock is cheap or a good investment. Most stocks, although not all, but most are appropriately valued most of the time. So why would a company trade at a low PE multiple? There's a lot of reasons. Maybe the market sees it as very high risk, cyclical, or there's high uncertainty in the underlying business. Maybe it has too much debt on the balance sheet. Or quite commonly, the market just expects the revenue and the earnings to decline in the future. Finding stocks with low PE ratios is really easy, but the job of a good stock picker is figuring out why the PE ratio is where it is. Let's look at this case study. International Business Machines, IBM. Over most of the last 10 years, investors have been able to buy this stock at a P ratio ranging between 10 and 15 times earnings. This is a substantial discount to the overall technology sector, where valuations over this period were 30, 40, 50 times plus earnings. So why so cheap? Well, when we look at the financials, we get the answer: declining revenue, declining earnings per share. The result: massive underperformance relative to those companies that were trading at higher valuations. Over the last 10 years, IBM stock was down 24% compared to a 450% gain of the NASDAQ 100. The bottom line: stock picking is an art and a science. The science is in analyzing the available data, but there's no formula, there's no simple calculation that's going to tell you whether or not a stock is undervalued or a good investment. You need to understand the underlying business. How stable are the earnings? Is the company healthy? Is the market healthy? Are the earnings expected to grow, decline, or just stay flat for the next several years? You have to make any necessary adjustments to the earnings before you rely on them. And that takes looking at the financials, a deep look at the financial statements. Keep in mind, low P stocks are typically cheap for a reason and high risk. Not always, but typically. The best strategy: focus on high quality growth oriented companies that can be purchased at reasonable valuations. Not the cheapest companies, certainly not the most expensive. And finally, we'll just end with a quote from Warren Buffett: it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And on this, we agree 100%, Warren.